Hi, everybody. It's at Homeowners Financial and doing our Tuesday tips a little bit differently today because it's about a spreadsheet. So, one of the questions that we get all the time is, oh, well, how do we calculate my debt to income? What are these like housing ratios? What are these things? So, I thought, let's share a spreadsheet and go through it together. So, I'm going to share my screen. Here we go. All right. So again, when we're talking about qualifying for a new home purchase or refinance, one of the big things is where do you qualify from a debt to income standpoint? Now, different programs have debt to income guidelines, right? FHA is 47 on the front, 55 on the back. Conventional could be up to 50 on both. And then jumbo loans could be 38 on the front, 43 on the back. So, what are these front and back ratios? So, let's do some math here very, very simply. So let's say your job pays you $150,000 a year. So 150,000 divided by 12. That's your salary, right? Let's just say that's how much you make each month. Now, let's say you also get your partner's job, right? So job two. Let's say that person makes around $50,000 a year. 50, 1, 2, 3, divided by 12. There you go. So you can see these numbers are populating in here, front end and back end ratio. Well, your front end ratio is your housing expense and related to your income. So in this scenario I did $1 million, 30% down, seven and a quarter interest rate. So property taxes again in the state of California are 1% plus bonds and fixed rate charges. This is a different calculation for the clients we serve in Colorado. This is a different calculation for the clients we serve in Arizona. This is the worst case scenario really for a California tax basis on your base taxes. Now, again, if you're in California and you're buying new construction, you might have something called Mello-Roos. Let's not go into that there. That's a whole different video. It's going to be great. So, when we look at taxes again, we're qualifying at 1.25% off the sales price. So this is a base $1 million property, 20% down. And then insurance in California, it's really going to be what coverage levels you want, but 150 bucks a month is about average for this $1 million price point. Now you'll notice right now our front end ratio and our back end ratio is the same. Your front end ratio again is your housing and expenses in relation to your income. So let's say your insurance is super expensive and it's 500 bucks a month. You can see how that changes the equation. Now that back end ratio is everything in the payments from your credit report and the rest of your life in relation to the income. So let's say you've got some student loans. Yes, even if they're deferred, you still have to have a payment calculated. Let's say your student loans are 150 bucks a month. Let's say you have a car payment of 500 bucks. And let's say you have credit cards, even if you use them and pay them off, it's going to be that minimum payment each month that is calculated and qualifying. So you use it and pay it off, maybe it reports 100 bucks a month, okay? Now, if you own other properties, this is a bigger, deeper dive question. Is it your primary residence that you're now going to rent out? Is it other rental properties? Is it second homes? For the intent of this video, we're going to keep it simple and say that there's no other properties owned. So when we look again, installment debt could be a piano loan, student loans, anything that's an installment. Your car loan, of course, is your car loan, lease or purchase. It's going to be hit with that actual payment. And then the credit cards is what that minimum each month. Now, to be clear, each loan program has different guidelines on how they will calculate this and whether you can exclude it. The intent of this video is to explain your front end and back end ratio and debt to income ratio of how it's generally qualified. So again, we look at our front end ratio to our back end ratio. Now, this would be a conforming loan. So conforming loans can typically go to 50%, no big deal. But what if we shifted our sales price to 1,500,000 and we did 20% down? Well, you can see those numbers a whole lot bigger than where the guidelines would be on a jumbo loan of 43 or 45%. Are there alternatives there? Yes, there is. But again, we want to look in how that qualifies. Let's kick that insurance back down. We can see that we've got some concerns here. Is there other income we can use to qualify? Is there a different person? Do you have bonus? What that would need to be to bring it back down from a debt to income perspective could be more money down, right? These are the variables that are go into it. So again, when we're talking about how you qualify for a loan, especially from that debt to income standpoint, it's going to be your income, typically what you make each month. It could be averaged over time, depending on the way that that's structured with bonus, salary, self-employment. It's going to be the housing proposed expenses, and it's going to be your other life together. I hope that gives a little bit of clarity. Stay tuned. I'm going to be doing another video on what happens if your appraisal comes in low. I'll talk to you soon, and please let me know what I can do to help you or anyone else. It's Austin at Homeowners Financial. Make it a great day.